Hello and welcome to Cost Accounting Data Analytics here at University of Maryland Global Campus. I am your host, Dr. B. Happy to be with all of you today as we discuss why it is that we study cost accounting and what the purpose of cost accounting is. First, it's important that we understand the elements that support the company's purpose and why the company exists. The first and foremost thing to understand is the strategic plan of the business. The strategic plan gives a snapshot of the roadmap that the company is following. It helps the company to understand whether it's a for-profit business or a nonprofit business, why it's important to put into action and establishing its direction. It's a roadmap. It's designed for the company to follow to understand where it is that it's going. The plan is wide-reaching. It's a set of documents that details the company's purpose, where it's heading to in the future, and it provides long-term and short-term methods for obtaining its goals. The strategic plan includes the organization's mission, vision, and strategy, which are the guiding principles of the company's existence. The components of a strategic plan involve the mission and vision statement of the company at the center or core of all of the business's activities. And around that core, the company directors, board of directors, management, CEO, CFO set goals and objectives for the company to accomplish. And then, of course, through those goals and objectives, we identify strategies and initiatives to take in order to meet those goals and objectives. Of course, these strategies and initiatives need to be measurable and attainable. And once we've identified those measurements and those targets, we hope to achieve those based off of our results. And of course, we compare those results to our goals and objectives, and then we make modifications in the future. And of course, the cycle continues. This is the conceptual framework of a strategic plan that helps to drive the company forward. Again, the strategic plan concept is that it is a roadmap for the company to follow into the future. The mission and vision of an organization starts with its mission, which is its purpose. Why does the company exist in the first place? The vision of a company is the narrative that describes the organization looking forward or to its destination to achieve by some future date. So in thinking about mission and vision statements, the mission is, why does a company exist? The vision is, how does the company plan on achieving its goal, its destination? And we want these mission and vision statements to be actionable, attainable, and driven by the organization and their strategic plan. The strategic plan helps to drive us forward to be able to reach our vision. And then once that vision is obtained, then of course we establish a new vision in the future. So in thinking about the strategic plan of the organization, we think of it as a roadmap. And with that roadmap, we understand what our mission is, our existence, and we use that mission to drive forward through the strategic plan and initiatives to ultimately achieve our vision. And once that vision is achieved, we can then set another vision for the future. Now, it's important to understand what the organization's goals and objectives are in order to ultimately meet our vision. How do we plan on measuring our ultimate progress toward meeting our visions through our goals, setting goals and objectives? The first thing we do is we look at the long-term goals, which are translated into short-term objectives to be met within the upcoming year. In accounting, we understand that the word long-term means 1 year or more. Short-term means less than 1 year. In order for us to meet our long-term goals in a year or more, we need to identify the short-term objectives in order to meet those long-term goals. We think of this as being baby steps or benchmarks, which are the short-term goals that ultimately fold into the long-term objectives. The strategic plan, which is the roadmap on how to obtain our long-term goals and objectives, includes the short and long-term goals that direct the organization forward to ultimately meet our vision. We look at a starting point of an organization through undertaking an examination of the company's strengths, weaknesses, opportunities, and threats. In business, we call this a SWOT analysis. It's helped to determine and understand what the business does well, what our weaknesses are, opportunities for improvement, and of course, the external threats to the organization. In looking and thinking about the SWOT analysis, we first identify what our strengths are, what we're doing well to help us to attain our goals, both short-term and long-term. Our weaknesses, areas of improvement to help to eliminate barriers and obstacles that are impeding us from meeting our long-term and short-term goals. Within opportunities, we look at areas of possible ways to improve the overall organization that are external to the organization. And through the threats, we identify potential external factors that might impact our organization in an unfavorable way. By identifying our SWOT analysis, strengths, weaknesses, opportunities, and threats, we can then set measures and targets to be able to measure and attain our short-term and long-term goals. And in thinking about measurements and targets, we utilize key performance indicators that help us to benchmark our performance in the company in order to meet those short-term and long-term goals. They are measurable, attainable, and actionable methods of measuring our performance to our target. And then, of course, once we have gone through the measurement process, we examine the results of our strategic plan. The results are typically both financial and non-financial information that is derived from the company's actual performance, and we measure that performance against our goals, targets. Every goal that the organization sets should be what we call a smarter or a SMART goal. The S in SMARTER stands for specific. It's very clear as to what that goal is. It's meaningful. It's something that we set out to do to make the organization better. It's achievable. We have the ability to achieve that goal in a reasonable expectation where it's not so far out that it's unattainable. So when it's achievable, it's attainable, realistic, and has an impact on the business. The goal needs to be relevant. Why aren't we doing this? It's very important to understand the why. The goal needs to be time-bound. Set a due date. Once you have a due date for your goal, it represents a time that it should be finished by. When should we achieve our goal? Is it a year from now, long-term goal, or is it a short-term goal, less than a year? We evaluate the progress toward making that goal as we make the progress. And then, of course, we readjust when our plan doesn't match our actions. Make some minor modifications in order to meet your goal. Even if we go past the time allotment, we still need to make our goal. So we readjust. That is what we call a SMARTER goal. In accounting, of course, we utilize the balanced scorecard approach in order to understand the performance measures of the company. The balanced scorecard takes both financial and non-financial information into account. You probably learned this in your managerial accounting course, also known as Principles of Accounting 2. And in that course, we discussed things like how to measure the company's performance. And the balanced scorecard approach takes factors like customer satisfaction, research and development, the execution of the business operations, and other financial and non-financial information into consideration. We look at this from a holistic approach. The balanced scorecard is used as a way of measuring the overall performance of the company and the financial health of the company. And it should be tied to the company's mission, vision, and strategy. Having everything integrated is very important in order for the business to all be on the same page, for everyone to work toward the accomplishment of the same goals and objectives. So to recap the balanced scorecard, we take into consideration financial and non-financial information. From the financial perspective, of course, we look at things like growth projections, target profits, and risk that the business takes into consideration. From a customer perspective, we look at things like customer satisfaction and retention. We look at business operations through a critical lens, where the company is establishing value for the customers and stakeholders. And of course, we also look at things like research and development, also known as learning and growth, which supports the overall infrastructure of the business to produce new products and services to grow the business. When the business takes needs of our customers and of the business into consideration, we think about Maslow's theory hierarchy of needs. Within this, we've identified the needs of individuals, the physiological needs, which include things like eating, sleeping, and well-being, overall fitness. We take into consideration the four walls, which are housing, health, monetary security, and overall sense of security. Once those are achieved, the next hierarchy is, of course, a sense of belonging within a community, a family. And then once the sense of belonging is achieved, we find a sense of self-esteem. And at the very top of the hierarchy of needs for all humans is self-actualization. It is the confirmation of why we do what we do. Yeah. So this is the overall hierarchy of needs that we take into consideration as we look at things like strategic planning, because this embodies not only our customers, but also our employees, our staff, and everyone else involved within the business. So what does this all mean in accounting? Why are we talking about business concepts? This is an accounting class. This isn't a business class. It is a business class. Accounting is business, right? And understanding that relationship as to why the business exists, its mission, and where the business is going, its vision, is critical for cost accounting, because we as accounting individuals need to understand our role within the organization and how cost accounting plays a major part in the business's mission, vision, and ultimate strategic plan. So we think about what is cost accounting and why does it matter to us? So cost accounting, of course, is how accountants help the owners and managers of an organization make decisions on what to do about their company, especially when we're talking about things like the strategic plan. The strategic plan is the roadmap for the company, so the accountants help the decision makers to understand and consider all of the related costs associated with achieving their stated goals and objectives. So with cost accounting, we are tied into all of these functional roles where decision makers make their decisions, and of course can take into consideration all of the costs associated with developing their strategic plan. The cost accounting role is not freestanding. It doesn't stand on its own. Accounting is not its own department. Accounting is embedded in all aspects of the business. And so that's why it's essential that accountants play a key role in the mission, vision, and strategic plan of the business. We accountants help management to make their decisions. We help them to understand the financial transactions that have occurred within the business, benchmark that with their goals and objectives, identify the financial reports, and then help management to make decisions based off of the income statement, balance sheet, statement of cash flows, and statement of retained earnings. And of course, as we're helping the decision makers, we include ethics in all of the decision-making process. So who are financial managers and what do they do? Well, of course, most organizations include a chief financial officer. This could also be the business owner if it's a sole proprietor. A sole proprietorship means it's just one person in the company. And so that one person is everything in the company. But the chief financial officer is ultimately responsible for finance and accounting functions within the business. And this individual is usually a key decision maker for the company. The financial controller is another individual who is responsible for the financial reporting process. This, of course, includes internal controls of the business, as well as supporting the financial process. Some companies also have a treasurer. This is the person who manages all of the cash and cash equivalents within the business. They also manage things like short-term investments. They issue debt and equities, and they build relationships with lenders. Of course, we think about cost accounting as being internally focused. A cost accountant to me means someone who's responsible for controlling process, procedure, and understanding all of the internal costs associated with the business. Financial accounting is externally focused. This is something that you probably learned in Principles of Accounting 1. In Principles of Accounting 1, we learned about the income statement, balance sheet, statement of cash flows, statement of retained earnings, the notes to the financial statements, management discussion and analysis, all of the things related to the 10Q, 10K, and other reports that are created on a regular basis. Those reports are for external stakeholders of the business. The internal stakeholders of the business, these are your management team, individuals working in the business. Cost accounting is internally focused, very similar to managerial accounting to that extent. Cost accounting is internally focused to help management make sound decisions, as opposed to what you learned in Principles of Accounting 1 with respect to financial accounting that present the income statement, balance sheet, statement of cash flow, statement of retained earnings to external stakeholders, such as investors, stock analysis, regulators, lenders, suppliers, competitors, customers, and non-management employees. On the cost accounting side, which is internal, it's not just a concept of costing individual products, understanding the raw materials, the direct labor, the factory overhead. It goes beyond those cost concepts that you learned about in Principles of Accounting 2. We also look at analyzing the activities and transactions from all aspects of the business, especially those that add value. And we look at it from the idea stage all the way through the execution. And of course, looking back at the external side of things in financial accounting, the reports, of course, are publicly traded information, so they adhere to generally accepted accounting principles or the international financial reporting standards, depending on the origin of the business. With respect to cost accounting, the reports can be arranged in any logical way, and they can be done at any time based off of the manager's needs. Very similar to what we learned about in Principles of Accounting 2. the internal focus. Management provides feedback based off the types of reports created. They're internal, and they're used by management to make decisions. That's in comparison to the publicly traded information, income statement, balance sheet, statement of cash flow, statement of retained earnings, that adhere to generally accepted accounting principles or international financial reporting standards. In cost accounting, we have a lot of different tools that we use to really understand the overall financial health of the business. And as you can see, everything is done with an ethical lens. In cost accounting, we look at very important pieces of information like the break-even point. Break-even point, of course, as you know, helps us to identify the number of units that we need to produce and sell in order to cover all of our operating expenses. We look at things like budgeting. Are we looking at an income statement-based budget, or are we looking at a production budget? Everything starts with a sales budget. The sales budget helps to drive the production budget, which helps to drive the raw materials, direct labor, and factory overhead budgets, which all help to drive our cash budget, which in turn is also related to our capital budget for making investments into the business. And we also look at other budgets that are very closely related. We look at concepts like net present value to understand things like interest and discount rates and what all that means for the future growth of our investments. We look at things like the contribution margin, which is the difference between the sales price and the variable costs. We look at things like regression analysis that involves statistical, analytical approaches to understanding things like margin. We look at things like segment margin, especially in a large portfolio business, to help us determine what the various segments of the business are producing with respect to margin. We look at things like transfer pricing between two different units within the business based off of their available capacity, what the transfer price setting situation looks like. Oftentimes, of course, we consider the market value price in comparison to the internal manufacturing price. When it comes to variance analysis, we're looking at the differences between what we actually paid and what we budgeted for. We look at things like the direct materials variance, price variance, labor variance, and a couple of other variances. And of course, we look at all other components of data that we gather through the development of the financials, and we analyze that information. We might use something like a vertical analysis or horizontal analysis to really understand our overall performance and benchmark that against the industry, competitors, and of course ourselves. We're looking at things over time. In the decision-making process, we first and foremost set ourselves out by understanding what the problem is and how to look at the related issues. Step two is we look at the information. We gather all of that information from both financial and non-financial information. We gather as much information as needed in order to start making assumptions. Step 3, we start calculating the financial data and non-financial costs to understand the cost benefit analysis. In step 4, we look at the option of maximizing our benefits to meet the required qualitative criteria. In other words, what's that goal we're trying to achieve? And 5, we implement our decision. This is how cost accounting is embedded in all aspects of the decision-making process within a business. When it comes to analyzing data, it's important that we look at both financial and non-financial information in order to develop a clear picture of the position of the company, which ultimately helps us to leverage the information that we have to find insights in order to make decisions. We take all of our data, financial and non-financial, put it into a database like Excel or Power BI in order to be able to visualize the information. When we analyze data, we often use descriptive analysis, which in turn essentially is a way to help us to identify patterns within the data. An example, of course, would be you take a lot of data points in Excel and you help to generate a scatter graph or a line plot or another chart to help you to visualize the trends and patterns. We often also use diagnostic analytics, which helps us to make observations in those patterns that we've detected, and we trace them to understand changes in cost. And of course, there's plenty of examples we could give with respect to changes in price. We track the change in price of something from day to day, put that information into Excel, and then, of course, draw your lines through developing your chart and your graph. We can understand through the charts and graphs the trends in the data. Predictive analytics is a way for us to be able to really understand where things are heading in the future. You can get a very good estimation of future cost based off the statistical analysis of the information that you have to be able to project out into the future. In accounting, we often do this through the budgeting process. And through our budgeting process, it helps us to understand what the future looks like with respect to cost. The same concept applies when tracking cost. We take that information, we analyze it, and we're able to predict within, of course, a variation of what the future cost looks like. Prescriptive analytics is how we're utilizing the data in order to make assumptions. This is the what if scenario. Oftentimes in accounting, we look at the potential for something in the future. For example, what is the potential a customer will make a warranty claim? Based off of that potential, I can use prescriptive analytics to find out the percentage of the possibility frontier of something like a customer making a warranty claim. We, as accountants, also need to understand the value chain from a perspective of cost accounting and how it relates to the business and the business's plan to move forward. We look at things like the costs of research and development. And then from research and development, we look at the costs of implementing a design of a new product. What are the potential raw materials, direct labor, and factory overhead costs associated with making that new product? And what does the supply chain look like to obtain the raw materials and the labor for these new products? Once it goes into production, we track the costs of things like factory overhead. And then we look at the costs of the associated sales, which include things like marketing the new product, sales commissions, sales salaries, and then how we're shipping it to the customer by looking at the related sales and administrative expenses. And then ultimately coming back to our administrative side, which is our customer service. And then we start the value chain process again. How do we look at the concept of adding value to the process? Well, of course, in manufacturing, we look at raw materials, direct labor, and factory overhead, and looking at cost conversion points for something that consumers would prefer. Within merchandising or retail, we look at things like selecting, curating, purchasing, receiving, displaying products that we've acquired through our distributors to be able to sell them to our target audiences. And for service companies, a service company might look at raw materials depending on the company that it is, but it oftentimes always considers direct labor and overhead costs that are used to improve the customer satisfaction. In supply chain, as cost accountants, we look at things like the process and activities to source the raw materials, to move them through work in process in order to produce the finished good and ultimately sell and deliver that finished good to the customer. We also examine the supply, production, marketing, and distribution activities and their related costs to understand the competitive advantage and overall success of the business related to the strategic plan set forth by the goals and objectives of the company. As you know, ethics is at the forefront of everything we do in accounting. We must always follow the laws set by Congress. We must always follow the laws set by the individual states. And of course, we must always do the ethical thing for our customers, our other external stakeholders, like investors, and of course, for the betterment of our company. And for Sarbanes-Oxley Act of 2002, which helps to govern all things that are ethics in accounting. Section 302 requires CFOs and CEOs to certify the accuracy of the financial statements, income statement, balance sheet, statement of cash flows, statement of retained earnings, related management discussion and analysis, all related notes, everything that is published in the 10K. Section 404 of Sarbanes-Oxley requires management of publicly traded companies, of course, to recognize their responsibility for establishing a set of internal control processes and provide an assessment of those internal control processes. Section 406 of the Sarbanes-Oxley Act of 2002 requires that publicly traded companies disclose they have adopted a code of ethics for senior officers. Oftentimes you'll find a copy of this code of ethics either on the corporate website, or you may also find a copy of these within the 10K report. The Institute of Management Accountants has also aided the development of ethics in accounting around the world. This is one of the largest and most respected associations, focusing on advancing the management and accounting profession. The mission, of course, is to provide research, practice development, education, knowledge sharing, and advocacy of the highest ethical best business practices in management, accounting, and finance. The vision, of course, is to help resources for developing, certifying, connecting, and supporting accounting and finance professionals in business around the world. I am personally a member of the Institute of Management Accountants. I have been for several years now, and I plan on sitting for the Certified Management Accountant certification. I strongly believe in this organization, and if you have questions about the organization, please contact me. I also encourage you to become a student member of the Institute of Management Accountants for your local chapter. IMA's statement on ethical professional practice includes the theory and principle of utilizing honesty, fairness, objectivity, and responsibility. There are specific standards of ethical professional practice that are including competencies, confidentiality, integrity, and credibility. If a member of IMA does not follow these standards, it may result in disciplinary actions or revocation of their certification. The Institute of Certified Public Accountants, AICPA, is within the United States, where CPAs belong to this organization. This organization also, of course, administers the CPA exam. If you're interested in becoming a CPA, I do recommend that you become a member of the AICPA. There is a lot of wonderful information on their website, and they do a lot of great things. They also have a code of professional conduct that includes responsibilities, public interest, integrity, objectivity and independence, due care, and the scope and nature of service. In thinking about this course and thinking about your drive to become an accountant, it's important that we embody this through a growth mindset. The fixed mindset believes that intelligence is static or set, but the growth mindset believes that intelligence can be developed and leads to a desire to learn. I believe that all of you embody the growth mindset, as you should have a desire to learn new things. This course and the framework of this course was built on Bloom's taxonomy, which is important to identified because this is the progression that you have been taking throughout your degree as you continue to work toward embodying and encompassing all of Bloom's taxonomies that is related to the learning process. So these are the things that we've learned in this chapter, and it's important that we remember these things, as it will lead to your continued success in this course. And with that, I thank you very much for your time and attention, and I look forward to your continued progress in cost accounting. Thank you very much.